Nobody warns you about the tax bomb sitting inside your retirement account quietly ticking until the government decides it's time to collect. We spent decades building this thing, and now Uncle Sam wants his cut, whether you need the money or not. Here's the deal. Once you hit 73, the IRS forces you to pull money out of your traditional IRA or 401k every single year. No exceptions, no negotiations. It's called a required minimum distribution, and it's basically the government saying, we've been patient long enough, pay up. The catalyst behind all of this goes back to 1974, when Congress created tax-deferred retirement accounts with a handshake deal. You defer taxes now, but you will pay them later. Later has officially arrived, and the bill is calculated using something called the Uniform Lifetime Table, which sounds like a furniture catalog, but is actually the IRS's formula for determining exactly how much of your own money you must withdraw each year. Think of your retirement account like a pressure cooker. Every year you delay taking money out, more steam builds up, and when the RMD valve finally opens, it can release more taxable income than you ever planned for. The irony is that the more disciplined and successful you were as a saver, the bigger and more painful that release becomes. We all remember the golden era of just max out your 401k and you'll be fine. And that advice wasn't wrong, it just didn't tell the whole story. The optimism of accumulation phase hits a very different reality in distribution phase, where suddenly every dollar you pull out is ordinary income, taxed at your marginal rate, not the favorable capital gains rate you'd get from a brokerage account. The psychological gut punch here is real. Retirees who feel financially secure suddenly watch their tax bracket jump because an RMD pushed them over a threshold they didn't expect. One financial planner famously described it as winning a race and then being handed the bill for the trophy. And that sardonic punchline lands because it's painfully accurate. Historically, markets have always recovered, but RMDs don't care about market timing. You must take the distribution even if your portfolio just dropped 30%, which means you're potentially selling low and handing that loss to the IRS simultaneously. Think back to 2009, 2020. Any crash you can name retirees in those years were forced to liquidate at the worst possible moment just to satisfy the government's schedule, not their own. The community of financial advisors, Reddit threads, and retirement forums will debate endlessly about Roth conversions. But the consensus wisdom is surprisingly unified. Converting traditional IRA dollars to Roth before 73 is one of the most powerful tax planning moves available to you. The catch, and there's always a catch, is that you pay the taxes now at today's rate, betting that future rates or your future bracket will be higher. A common misconception is that RMDs only affect the ultra wealthy. But the reality is that a modest $400,000 IRA at age 73 produces an RMD of roughly $15,500, which can easily push a Social Security recipient into a higher bracket and trigger additional Medicare surcharges called IRMA. You're not just losing money to income tax, you're potentially losing money to healthcare cost increases simultaneously, which is a compounding penalty most people never see coming. The practical lesson history keeps teaching us is that tax diversification, having money in taxable, tax-deferred, and tax-free buckets, is the closest thing to a cheat code that retirement planning offers. Moderate, deliberate Roth conversions in your 50s and early 60s, even when it feels painful to pay taxes early, is the disciplined and unemotional strategy that consistently outperforms the "I'll deal with it later" approach. Position size matters enormously here. Don't convert so aggressively that you spike your current bracket, but don't convert so timidly that you leave the problem completely unsolved. Discipline is doing the math every single year, adjusting based on your income, your bracket, and your projections, not reacting emotionally to a scary tax bill you didn't anticipate. At the philosophical level, the RMD conversation is really about who controls the timing of your own wealth, you or the government. The investors who win this game aren't necessarily the ones with the biggest accounts, they're the ones with the most thoughtfully structured accounts, because structure determines how much you actually keep. And here's the beautiful absurdity of it all. The tax code giveth with the left hand through decades of deferred growth and taketh away with the right hand through mandatory distributions timed to someone else's schedule. But knowing the rules of the game, really knowing them, means you can play it strategically instead of just reacting when the bill arrives. Whether you end up with a massive RMD problem or a perfectly optimized tax-free retirement, what matters most is that you made intentional decisions with clear information and consistent discipline, not guesses driven by fear or inertia. The size of your account matters far less than the structure, and the structure is something you still have time to influence. If you want help building that structure, whether it's through real estate investing, connecting with the right lenders, or finding contractors for income-producing properties, check out our links in the description below.